Plenary 3, as you can see, is around the world in 60 minutes, and the organisers have assembled a wonderful panel of people to address those the issues that come up. I mean, we've seen in the last week the Federal Reserve increasing interest rates. On the one hand, some signs that the economy is looking more robust. On the other hand, the President has landed his budget with a thud. There's been a sell-off on the markets overnight as people begin to wonder whether or not he'll be able to get his tax cuts through Congress and his cuts to regulation through, and some worries there. Are you optimistic or pessimistic?
I'd say on balance probably relatively constructive, because if you abstract from the politics for a moment and just look at where we are in the US, we've been in an expansion for about 8 years now, and it's been a disappointing expansion of about 2% a year. A part of the reason it's been capped at 2% was we had very little investment in the US in general. Again, abstracting from the politics, a lot of the tax cuts which are being considered right now, those would induce greater investment. Cuts in corporate taxes, a cut and the ability to repatriate profits into the US, potentially an infrastructure bill. Looking forward, maybe not this year's business, but over the next few years, we might see some acceleration of growth.
My view is that the markets are engaging in a little bit of irrational enthusiasm, that the Republican Party really can't agree. I don't think you can abstract from the politics at all here. The markets are fundamentally being driven, I think, by expectations that they can literally that they will literally be able to have their cake and eat it too. What would be really cause for optimism here would be if the infrastructure problem could be solved and we could get public investment at the level that we need to deal with our multi-trillion-dollar deficit. If we got that, we would also, I think, see, it would necessarily be involving expansionary fiscal policy, and it would continue to drive improvements in our labor markets, which would then kick off private investment.
I think actually the rally in markets predated the US election, and what we saw in the summer of last year was an improvement in leading indicators of economic activity all around the world. And effectively the Trump victory amplified that trend because it increased this hope for fiscal stimulus in the US. So I think at this point maybe we definitely would be reducing our exposure to US equities. We think they are very richly priced, very much predicated on this assumption that Trump can get his measures through Congress. But actually, in the meantime, we see quite a lot of opportunity elsewhere around the world, because actually, in the meantime, those leading indicators of economic activity are still improving.
I would say that thinking about, the investment the investment profile of super funds, there's no circumstance, I think, in which you all won't be invested in the United States and invested in a significant way. The deeper issue in the U.S. is twofold. One is, and I think we've all been sort of touching on different ways, the long-term issue of wage stagnation and relatively slow growth, meaning the 2% number that we saw in the last 8 years. And the roots of that in terms of imbalances in our economy is problem one. And problem two is that is really a political economy problem, but it's really going to matter if you're investing in the United States, which is that Donald Trump, as a response to as a political response to long-term wage stagnation, is clearly destabilizing key elements of our political order.
I'm looking at something that the Sydney Morning Herald's reported this morning. It's a Wall Street Journal editorial that talks about, rips into the president for what it describes as his seemingly endless stream of exaggerations, evidence-free accusations, and this goes to Damon's point about the established political order and how much of an investment risk you see that has been. I want to just quote you before I get your sense of the implications for this region. The president clings to his assertions like a drunk to an empty gin bottle, rolling out his press spokesman to make more dubious claims. So is that threat to the established order, as Damon says, a concern for investment, or is that just a sideshow from the White House, and the fact that he can't get a lot of this stuff through the Congress means there's a break on any concern?
No, I think it does matter for markets. I mean, I think you're already seeing a bit of a disconnect in the US between where the level of interest rates are and where the US dollar is. So the US dollar is probably not performing as strongly as people thought it would, given the better economic news we've had in the US and given the repricing of interest rates. So our sense is that some of that discount in the US dollar probably reflects a sense from global investors that there needs to be some sort of premium priced in for, I guess, a more unusual or uncertain environment for politics in the US.
In terms of the impact on currencies, I actually have a slightly different view. I do think that the euro and the yen over the longer term, over that 3 to 5 years or even 2 years, are going to be driven more by interest rate differentials. Neither country is really in any place close to the inflationary environment that we're likely to get in the US.
I think no industry is really sheltered from the pace of technological change. So actually, I would say that that is not an issue that I would ascribe specifically to infrastructure or any single sector. I think the reality is that the pace of innovation is very significant. And in fact, it's something we should also consider in the context of questions about, the ability of Trump to get wages up, for example, because actually in the meantime, and there's been this whole debate going on, is actually a lot of it's about not work being outsourced to other economies, is actually that people are being replaced by automation.
I think the question that most Americans are wrestling with in a serious way about Donald Trump is that his administration points in so many different directions. And which direction is he actually going to move in?
And does it matter? I mean, I think we just need to keep bringing this back to how fund managers assess risk and opportunity. Does it matter? I mean, is there sufficient stability in the US system? Are there enough wise heads in Congress, in a Republican-dominated Congress, to frustrate the most erratic of presidents and ensure that there is a stable investment environment with potentially the upside of major infrastructure spending? I mean, I think that's the bottom line.
I think that's pretty much a way of putting it. I mean, you can look at what Donald Trump is saying and you can conclude that he is really bent on a sort of long-term social confrontation between the people who voted for him and America's rising majority of people of color. You could say that that's his agenda. And if that's his agenda, that's a serious matter for anyone with long-term investment in the United States. Or you could look at his agenda as being one of really trying to break the logjam in terms of public investment and trying to put the way in which we engage in globalization on a more sustainable path politically.
What are the implications for investment markets if the rest of Europe becomes unstable post-Brexit? Gosh, post-Brexit, that's hard to say. Sonal, do you want to embrace that one?
Sure. I'd say that perhaps the extent to which Brexit has influenced the euro area and the Eurozone has been exaggerated somewhat. I think it was the same factors which fed into Brexit, which are feeding into populism more broadly in the Eurozone. In many ways, I think that what's happening in the Eurozone is a lot less benign than what's happening in the UK, which ultimately it's a trade issue between the UK and the Eurozone. Hopefully, that's how it would probably end. But in Europe, if you do have one of the Eurozone countries moving in the direction of, say, potentially a French election, giving us a big surprise, which we don't think is the baseline, but then we didn't think Trump was the baseline, we didn't think Brexit was the baseline, so you can't ignore it. I do think that that's where political risk is more serious, and it does have implications. It will be quite unstable.
I think basically Brexit broke a taboo. Until the Brits decided to vote to leave, it was unthinkable that anybody would do that. And I think they did it. So that's kind of set a dangerous precedent.
It's one of the regions in the world where we've probably made the most in terms of forecast upgrades in the last 3 to 6 months. So we like European equities. They look reasonably cheap relative to other assets. Europe is earlier in its recovery than some other regions, so that tells you that maybe the rally can sustain.
There is no way in which it will be possible to enjoy the types of returns that I think, have been used to from the 20th century, as long as the world economy is run in such a way as to repress wages.
The implications for the New World Order and for China, how would you address that issue? Start with China, why not?
Yeah, sure. I think that it's a case where China is going to be fairly careful in this new world order. They tend to be cautious at the best of times. And I think that if we saw an outright trade war, which was, if we saw the type of policies which were being campaigned on, so across the board tariffs, et cetera, you would be in a situation which would be very highly negative for China. I think China is going through its own political transition this year, and so they are unlikely to be willing to engage in a trade war unless they are forced into it.
China have been, I guess, watching very carefully what's playing out in the US, and I suppose when we think about, how Trump might affect some of his agenda, the one thing that sort of strikes us is that, yes, you have a Republican Congress and you hopefully have some sort of wiser heads in Congress there, but then Trump does have considerable power through executive orders to sort of get what he wants. We've seen that with some of the travel bans. A lot of that relates to trade as well. So there is scope for him, I think, if he wanted to go down that path, to be reasonably aggressive on the trade agenda. China is saying all the right things, like they're for global trade, they want to participate more in global trade, but I have no doubt that if the US starts to move more aggressively on the trade front in whatever form that might take, China will retaliate, and that would not be a good thing for the world, and it wouldn't be a good thing for us.
So firstly, on China, the only comment I would make is that actually in the current world order, China's a source of stability.
I agree with everyone else who's spoken that the U.S., having a constructive U.S.-China relationship, both economically, politically, in the security space, is really central to global prosperity and stability.